What's up everybody? In today's video, we're going to be going over the 5th company on my watch list. These are all companies that I have thoroughly investigated and determined to be great companies that I'd eventually like to own. The only problem is that they are too pricey for my liking at the moment. So what I do is I place them on a watch list and patiently wait for a better opportunity to buy them at a more reasonable price. Because there are 8 of them and the full video is going to be longer than most of you would like, I broke them up into shorter videos on each stock. You'll be able to find all the individual videos by following the link to the playlist right up here. You can also click on the thumbnails at the end of each video and it will take you to the next stock on my watch list. So without further ado, let's get started. Next up is one of my favorites, and it's Arista Networks, ticker ANET. Arista competes with Cisco, Hewlett-Packard, Dell, and several others in the network management space, where Arista's high-performance Ethernet switches paired with its open and programmable software is taking advantage of the gaps in traditional networking. Arista currently has the most market share in the high-speed switching market and is looking to expand and take market share from Cisco in the lower-end markets as well. Arista's value proposition appeals to a large portion of the network management market, but it specifically appeals to large-scale cloud companies like the Magnificent Seven, cloud service providers, and next-generation data centers and campuses involved in AI and other next-generation technology because it increases network speeds and it drives down the cost of managing a network. In fact, Microsoft and Meta make up 39% of Arista's sales, which can be seen as a positive because of the size, strength, and CapEx budgets of those two tech titans, but it also presents a risk as we saw in 2019 and 2020 when Meta decided they were going to skip an upgrade cycle. Arista's revenue dropped 20% right here from peak to trough. When only a couple companies have that big of an impact on a business, you better be aware of it. They hold a wide moat due primarily to switching costs, but their market position in the high-speed market combined with product differentiation also contributes to the competitive advantage. Switching costs are the costs that an existing Arista customer would incur if they decided to switch to one of Arista's competitors for its network solutions. Arista's proprietary software and hardware configurations require training and certifications, which can require weeks of class, hours of testing, and tens and thousands of dollars in expense. Furthermore, networking setups take months to implement and years to optimize. If a company were to switch away from Arista, it would require wholesale retraining of its workforce under a new vendor, inclusive of the time and expense to do so. Arista is growing like gangbusters, with revenue up 30% plus per year over the past 3, 5, and 10 years, while earnings are growing 50% per year. Cash flows are also growing rapidly, but it can be a bit deceiving as a result of the huge increase in free cash flow in 2023. Prior to 2023, their cash flows were stagnant, due primarily to the large research and development and CapEx spending required to grow market share in their end markets. It will be interesting to see what level of free cash flow they print in 2024. If Q1 and Q2 are any indication, 2024 is off to a good start. Profitability is a mixed bag with a baseline return on capital at only 15 to 20%. It's still a level where internal investments are creating value, but not at the level that I would expect. Cisco's return on capital also falls in this 15 to 20% range. It appears that the large investments into R&D, CapEx, and manufacturing required to compete in these networking markets naturally limit the return on investment. But if we turn to the operating and net profit margins, we see a beautiful thing. High and increasing margins, supporting the notion that Arista enjoys a competitive advantage in the industry. The main disappointment I have with Arista is the lack of shareholder returns. They don't pay a dividend, and they don't buy back enough shares to offset the dilutive effect of stock-based compensation. This is a pure long-term growth bet. Arista is focusing on expanding market share and growing revenues, so they're plowing most of the cash and earnings they generate back into the company to achieve those two objectives. The only payoff an investor gets with Arista is price appreciation, which has been great, with a 536% return over the past 5 years and a 1,724% return over the past 10. This rapid appreciation is one of the reasons I don't currently hold Arista, and you find it on my watch list. It's just a bit too expensive for me at the moment. It carries a 41 forward PE, 19 times price to sales, and a 2% free cash flow yield. Morningstar values it at $270, while CFRA values it at $323, and I put a $276 valuation on it, but with a 20% margin of safety, I'd only be willing to pay $221 per share. I'm on the sidelines waiting for a nice dip. If you're interested in a deep dive on Arista, I did a video a month or so ago. You can check it out here. Well, that will do it. I'd love to hear your thoughts on Arista Networks in the comments. Are you a buyer or a seller? If there are any other companies you'd like me to take a look at, feel free to leave them in the comments as well, and I'll eventually get around to them. Also, please make sure you like this video and subscribe to my channel so you don't miss any videos when I release them. It's a quick, easy, and free way you can help me grow this channel if you find this content valuable. Lastly, to continue to the next great company on my watch list, click on one of the thumbnails that you see on your screen right now. Until next time, you all take care. I'll see you in the next one.